Yes, thank you so much. But,
Yeah.
you got it in there? Okay. You see the shot.
Yeah, I can't open chat for some reason.
Okay.
Yeah.
I will. Recording already? Good.
Okay, well, greetings, everyone. Okay. Well, welcome to this workshop sponsored by the Alliance Business Center in Thornton and SCORE. What we're going to talk about tonight is simple steps for choosing the right financing, or maybe you want to call it financing options. I think that's the way it was kind of promoted online. Either way, what we're going to be talking about is some of the resources available to small business owners for financing. And when I talk about financing, I'm talking primarily about debt, right? So this is, although we're going to talk about other kinds of funding, primarily we're going to focus on financing. The world of small business lending has changed a lot in the last few years. While local banks were usually the first place a business owner would think of when they needed a loan, today it's not the only place where small business owners can find loans and other kinds of finance. Today we're going to talk about what's different in the world of small business finance compared to even just 5 years ago. I'd like to acknowledge a couple of people or a couple of organizations that have made this presentation possible, that being On Deck and SCORE. SCORE does a lot of work with partners, and On Deck is one of the financial partners, fintech partners that SCORE has worked with to put this presentation together. My name is Mike Lyons. I'm going to be the facilitator for the workshop this evening. I've been in the career world, professional world for 40 some odd years, and most recently worked in software and in consulting, where I sold a number of companies, was involved in a couple of startups that weren't successful, but also had an opportunity to work with a lot of very smart people on the topic of finance and learned a lot during my career. So I'm really hoping today that I can share a lot of that with you. Since we're going to be talking today about money and how important money is to small business, I kind of feel like I have to give you a bit of a warning. You might find a similar kind of warning on a bottle of wine or beer or maybe some medicine, but it's a warning to say money is a great servant, but money is not a good master. If you find yourself in a place where you're all about money, you're probably focusing too narrowly. And you need to open your aperture up, and you need to think a little more broadly with respect to resources you have available, and recognize that you get no rewards for exiting this life with a bunch of money in the bank. So put money in the proper perspective. That's my encouragement. I'd also like to say that during the course of this conversation, we're gonna talk about a lot of different financing options. And because of the wide variety of organizations and people on the call today, not all of these are going to be applicable to your business. So think of it in terms of some financing options are going to be great for startups, but they're not going to be so great for maybe mature businesses, and vice versa. So as we go through these options, I'll try to remember to mention which stage of small business these financing options work best for. But if I don't mention it, ask the question, because ultimately a big part of knowing where to get the right financing has to do with where your business is and what you want the financing for. So let me do a little shameless advertisement for SCORE before we jump into this. SCORE is made up of a series of volunteers that are available to do a number of things, seminars, workshops like this one, as well as mentoring. If you're interested in mentoring or getting a mentor, that link that's shown on this page is a good resource for you. It's important, I think, when you're considering where to get funding for your business, that you talk to a mentor, whether it's through SCORE or somebody else, just to help you kind of think through all of the various questions and options and details that come along with getting financing. You can see also the link there for the Denver SCORE chapter. Now, SCORE isn't the only organization that offers mentoring resources. You can also go to the SBDC, you can go to the Colorado Office of Economic Development. The CASA Resource Center is another one. Rocky Mountain Microfinance Institute is another. So there are a lot of different resources that are available to you as a small business owner, where you can find information or you can find mentors to help you with this notion of finding funding, or finding out what your funding options are. The last one that's listed here, the Denver Public Library, is an interesting one. If you're not familiar with their BizBoost program, I would encourage you to look that up. That is a free service through the Denver Public Library, where they do a lot of different kinds of research for you that will help you in your business, and not only understanding funding, but understanding markets that you serve, competition, tax base, all of those kinds of things are available through that program. It's helpful to small business owners. So for the agenda today, we're going to talk about credit considerations. We're going to talk about typical types of funding for small business, where we'll look perhaps past the financing or lending piece to other types of funding. We're gonna talk about 5 different options available to small business that I think will be helpful to you. We'll talk a little bit about what approach is right for you and your business based upon a number of different criteria. There's a page at the very end with regards to information and references, and then we'll leave some time for questions and answers. If you're online, please enter your email address in the chat box so that we can send you the slides and notes for this workshop. It's a helpful way to make sure that we send this information to you. Unless you're present or participate in the workshop, we won't know that you're here. we want to make sure that we get all the information available for you. So if you would do that, that would be great. As we go through this program, I have to kind of make a disclaimer that admittedly, I don't have all the answers. Funding is a broad topic. There's lots of detail, lots of different kinds of loans and programs and approaches for funding and financing. But I want you to ask your question anyway, because if I don't know it, I'll go find out and I'll share that information back to you via email along with all the other participants in the program this year. So it's helpful if you ask your questions. Or if you happen to know the answer, share the answer with us. That would be helpful. Now let's talk about something before we get into the meat of the conversation this evening. Let's talk about something that's really important. That is your personal and your business credit profile and credit scores. It's something that a lot of people overlook when they're out searching for funding. And it's something that we can work on every day, but unless you're aware of the fact that your credit scores are going to be considered when you apply for debt or financing of any kind, really, it's important to know what people are looking for. So your personal credit score, as well as your business credit score or business profile, are things that are available online that many lenders are going to look at. If you're a startup business and haven't really kind of cracked the egg yet on getting started, you need to realize how important your business credit score is going to be to you as you get started. On the other hand, if you are in business already and you're successfully doing business with customers and partners and vendors, you already have developed a business credit score or a business credit profile. So it's important to recognize that the two are different, but they also work hand in hand when people evaluate your credit. When looking at a personal credit score, there are typically 5 things that are considered in that score. First, your payment history. So that makes up about 35% traditionally of the score that you're going to get. How well do you pay your bills? Are you paying on time? Are you paying the amount that's due? That kind of information. The next kind of criteria is the amount that you owe, followed by the length of your credit history. How long have you been borrowing? If you're fresh in kind of the work world and don't have a lot of credit history, this may work against you. If you have a good credit score and you've been doing it for a long time, this will definitely work. Other kinds of credit that you've used also was considered, so different types of credit use, as well as the number of times you've accessed your credit score or others have accessed your credit score. So all of those things kind of make up your personal credit score. From a business credit profile perspective, lenders that are considering lending your business money are going to look at your personal credit score. But additionally, they're going to look at your cash flow. So what kind of cash flow do you have in your business? Is it a cash flowing business? They're going to look at things like annual revenue, time in the business, how long have you been doing it? They're also going to consider things like industry. What industry are you in? How is that industry doing with respect to the overall economy? Those kinds of things are all going to inform a lender about how loan worthy you are with regards to your business. Another thing to consider when you're thinking about your credit are what we call the 5 C's of credit, or 6 C's of credit. And these are important to keep in mind they kind of are a holdover from sort of years gone by when everybody got a loan from a local bank. But they apply just as much today as they ever did with respect to giving people an opportunity to know who they're doing business with, who they're lending money to, and so on. The thing here to remember is that emphasizing the relationship with your lender is really important when you're starting to build your business. If you decide to go to a local community bank or credit union or whatever, you're going to want to know those people at that bank, and you're going to want them to know you. If you decide to use an online lending source or other kinds of lending sources, you're going to want to be able to know them well, and they're going to need to have good information on you in order to know that you're trustworthy and you'll manage their loans well. So here are the 6 things that make up the 6 C's of credit. First is character. You might make that might be an easy one. We're talking here about trustworthiness, integrity, your personal and business credit history, the quality of your references, your experience in business, things like that. The next one, capacity. Here we're going to talk about things like, is your company able to pay the money back that's being borrowed? Do you have and can you generate a positive cash flow with the money that you're getting? Will you be showing a profit? What kind of profit will that be? And can the profit be sustained? So those kinds of things fall under the title of capacity. Recognize that when somebody's loaning you money, probably the first thing foremost in their minds is, am I going to get my money back? And if you represent a high risk, it's going to be harder to get that loan. The next thing is collateral. Do you have an alternative source of repayment? Do you have a third-party guarantee? Is somebody helping underwrite this loan for you? Do you have tangible assets, maybe property or equipment or inventory that are available to be used as collateral? And do you have accounts receivable? If you've been in business a while, do you have an AR or accounts receivable balance that represents cash that will be coming in from business? The next thing is capital, right? Do you have personal money invested in the business? So think of it in terms of you go to someone and ask them for a loan, but one of the first things they're going to ask you is, do you have your own money invested in it? Why would I want to invest money in your business if you're not willing to invest your own money? So that's a form of capital that's important to consider. Do you have a way to build owner equity? Is your business representing a growing owner equity? And is there indications from your balance sheet and from your income statements that you're putting money away for your business? Next one are conditions. What's the intended purpose for the loan? How much are you requesting? Is this a short-term loan? Is this a long-term loan? Those kinds of things are important for people to understand. Some other things that fall under conditions would be, what is the economic climate for your industry? And then what's the economic climate in your local area? Are there changes that are occurring or maybe signs that the economy is slowing? These are going to be things that lenders are going to want to consider. Last but not least, and maybe most importantly, lenders are going to look at cash flow. How do you cash flow the business? Where is the money coming from? And how are you going to use that money overall? not just how you're going to repay your debt, but also where is the rest of the money going? How are you using it? Are you using it wisely? Do you have other debt that you're paying? That kind of information is all going to be considered when people start thinking about lending you money. Now, I will say, and you'll hear this as a theme over the next bit that we're together, traditional banks tend to look at this more in a more focused way, these 6 C's, than perhaps online lenders do. And we'll talk a little bit about the difference between traditional banking and online banking coming up. But regardless of where you go to find a loan, it's important to recognize that these are going to be considered. You should have a relationship with your banker or the source of lending, and you should consider these 6 C's as you think about how you're lending and applying for loans. Next, I'd like to chat a little bit about not just lending or loans, but other types of funding that are available to you. We're not going to talk a lot about these except for borrowing, the last one down at the bottom. But I wanted to make sure that you were aware of these before we got too much into to the heart of the presentation. So one of the things that we often hear at SCORE that people ask about are, where can I get free money? I hear about, the economy is doing pretty good, and I hear other people telling me stories about getting these great loans or great investors, and I see examples of people getting what looks like free money, and I want some too. And I think that the hard reality is that there really isn't any free money out there. But the thing that comes the closest is going to be your business cash reserves. So the reserve cash that you have in your business that is available to you, that you don't have to pay debt on. You don't have to forfeit ownership in your company via equity, and you've got it available sort of as you need it. Now, I know a lot of small businesses don't have a cash reserve available to them, but that's one of the things that we encourage people to do, kind of like even in your personal life, where you're encouraged to save even a couple of bucks a week, put it aside, start building those cash reserves in your business so that you have it available to you as you move forward. So business cash reserves are a huge part of where you can find funding for your business. The next two are really talking about equity investments. So equity investments by owners and equity investments with external resources. So equity owners get a share of the profits of the company. That means that typically when you have a profit, equity owners have usually an entitled right to some percentage of that profit. Now, sometimes that's done in dividends, sometimes that's done in distributions, but generally speaking, equity owners, particularly internal owners, have access to capital. The other thing that is important to recognize here is that if you sell your business, or when you sell your business, your equity investors also share in the proceeds of that sale. So let's say I have an equity partner, they own 10% of my business, I sell my business for $10 million, that equity partner is typically entitled to $1 million or 10% of that sale price. So generally speaking, when you have an equity partner, it's important to recognize that they're going to share in the proceeds and in the profits of your business. The same thing applies for external equity investment. Here, what you're going to find is that oftentimes external equity investors can come alongside you, they provide you cash that's needed for your business. Oftentimes, they can also provide experience and connections and help in running your business, so they do that usually very well. But when you think about an equity investor, think of somebody who's going to get involved in your business for a period of time. It's not unusual for equity partners to get involved for 3 to 5 to 7, sometimes even 10 years, based upon the type of business. But you're going to have to like these people. You're going to have to deal with them and work with them on a regular basis. They're going to be partners. So that kind of equity investment comes with some baggage, some things that you're going to have to be used to if you decide to go that route. The last topic here is borrowing. And you can keep control of your profits and your sales and all of that kind of thing if you don't have equity partners or equity investors. And generally speaking, borrowing or debt tends to be a lower cost source of funds than equity is. There are some trade-offs, and generally speaking, those trade-offs can fluctuate from business to business, but generally speaking, debt is going to be a lower cost source of funding. Recognize, however, that when you do take on debt, this is no surprise to anyone, your business will need to make payments. You're going to have to pay that debt back, and if you can't pay it, your business or your personal assets will be at risk. Something to keep in mind here, and I want to be truthful, borrowing typically is not the best source of funding for startup businesses. Most banks, most lending, online lending companies are going to want you to have been in business for at least a year so that they've got some sense of your financial stability before they lend you money. Now, there are some exceptions to that, and there are also certainly some other sources of funding that we'll talk about. But generally speaking, borrowing or debt is not the best solution for somebody who's just getting started. I'll also kind of share a story with you that I had first-hand experience with. One of my SCORE mentees had kind of a tough experience with debt. What he did was he owned a service company, and he borrowed $15,000 from a merchant cash advance company. So this was basically merchant cash advances are basically companies that will loan you, funders that will loan you money based upon your future sales. And the way they do that generally is they'll loan you the cash. In this case, it was $15,000. But what they do is they set up an automatic withdrawal from your business account on a weekly basis, based upon your weekly receipts. So it's generally a percentage of your receipts. So if your receipts are high one week, then they take more. If your receipts are lower one week, they take less. But that's a tough way to go. That's expensive, and it really makes it difficult if you're managing your cash flow day to day, like many businesses are. What wound up happening was he got started on it and found himself in a position where he was cash poor. He was bringing in a lot of revenue, he was bringing in a lot of cash, but that cash was getting sucked out by his lender. So we sat down and looked at various options of ways that he could work around this or deal with this. And ultimately, what we came up with was the idea that he needed to find a way to pay that debt off. And so what he did was he went to friends and family, and he got one of his friends, actually his sister, not his friend, his sister, loaned him $15,000 to pay that debt. Now, he owes his sister $15,000, but those terms are much easier to do. So what the moral of that story is this business owner would have been a lot better off had, instead of going for something that was easy, some easy debt to get, like a merchant cash advance. Instead of going that direction, he would have been better off, and ultimately it was what he had to do to get out of the bind debt. He would have been better off to go to friends and family. And one of the things that I would encourage you to think about, particularly if you're in the startup mode, friends and family are a great way to fund your business. Oftentimes, you kind of think about, oh my gosh, I don't want to get into debt, or I don't want to be a co-owner with somebody in my family or a friend. You know, I want that arm's length distance. But if you give it some thought, oftentimes friends and family are your best source of funding, particularly if you're getting started, or if you've been in business a while and you need an extra boost in cash. I would encourage you to think about taking that direction first and exhausting that before you try other sources of equity or debt. Sometimes that doesn't work. Sometimes you don't have the ability to do that, but that is oftentimes going to be the easiest and cheapest way for you to move forward. So let's look at kind of a spectrum of different sources of cash or sources of funding that are available to you. We talked a little bit about friends and family. I would tell you that most of the people that I work with in SCORE that have ongoing businesses start there. Even if it's just $5,000 or $10,000 to get them started, that's where they start. And that's where it's generally speaking the best place to begin. Next are equity investors. We've talked quite a bit about those. In startup businesses, you can find angel investors that are focused on early stage companies. Venture capitalists and other private equity generally focus on later stage companies. But equity investors are definitely a way to go, particularly if you're looking for long-term, larger amounts of capital. Community development financial institutions are another source of funding. And we'll talk a little bit about those a little later on when we talk about nonprofits, so I won't get into that too much. Then you've got the Department of Community and Development, Economic Development. They often have grants and other funding resources that are available to small businesses or businesses that are just starting out. And that certainly is worthwhile researching and looking into. What we're going to be talking about today are those boxes listed in red. So we're going to be talking about online lenders. We're going to be talking about fintech or financial technology. There's also another group of funding sources called peer-to-peer. These are kind of like banks, but they and private equity, but they tend to be very focused on a specific industry. We're going to talk about crowdfunding and then Department of Agriculture and Rural Development. We've also got some grants and some funding resources that are available to those departments and that are underwritten by SBA and some cases. So those are kind of a broad spectrum of different funding sources that you might have available to you. I'm going to stop here and see if there are any questions. If you do have questions, drop them in the chat box. We do have a couple of kind folks that have showed up to brave the weather today. So any questions?
As far as business cash reserves, is that typically, or like not at all, can it be the same as either cash on hand, some form of profit allocation that's maybe like distributed, quarterly or whatever, or working capital? Or is it completely a separate
No.
process?
You can consider it either working capital or cash on hand. The other scenario you mentioned sounds like it's obligated cash that may go into some sort of profit sharing.
Mhm.
Generally speaking, you don't want to have to tap into that. You can in emergencies, but you want to set that aside.
For sure.
So let's see here. Somebody's got a good question. So somebody mentions secured credit cards, a good way to build credit. Looks like we've got somebody else mentioning that when they inquired about this with their bank, the first thing they did was help me with a dispute on the credit report. So, but there are, we won't talk too much about the use of credit cards in business. There's certainly a resource available to you. But I think it may be worthwhile to look at other types of lending that we'll talk about as opposed to using credit cards, because oftentimes credit cards, particularly if you're going to be using a personal credit card, they're not going to really be helping you a great deal with your credit profile in your business. So it's something to keep in mind. Okay. For the next slide. So I mentioned earlier there was no free money, and I think that's something that a lot of people might want to dispute. But the fact of the matter is that it's really hard to find those kind of great deals. So finding a loan as a small business can be really time-consuming and a very tedious and stressful process. The Federal Reserve Bank of New York reported that the average small business owner spends about 33 hours in finding a loan or finding funding for their business. And keeping in mind that generally is every time you go out to find a new loan. So it's a very time-consuming process. Days when you were able to go into a local bank and walk out with a loan, that's become harder and harder as well. So it's important for a number of reasons to know the various sources of where you can find funding. It's kind of the idea that if you know where your funding sources are and what's available there, it makes the process much easier. So the good news is that there have been a number of changes in technology and a number of changes in sort of innovative ways that banking and loans are done over the last 10 years that make access to cash much easier. You just know where to look. You need to know where to look. So for the next hour or so, we're going to chat about those different places where you can find sources of cash through debt to help you out. So let's talk a little bit about sort of what this looks like. Skip the slide here. So what's happened is innovative companies are using technology to match your financing needs with a new breed of small business loans designed to help you as a small business owner. It's important to note that even with these advances in technology and the new access to capital, the raising money takes time and effort, and probably most of all, being knowledgeable about the choices available to you. And kind of in much the same way, technology companies like Amazon, Priceline, Zillow, Uber have changed the way we shop and we travel, we buy a home, or we hail a cab. technology is changing the way many business owners get a small business loan. That last box in blue, titled at the bottom, references the changes that are taking place in capital lending, where local banks were the primary source of lending for small businesses 20 years ago. Now technology and new innovative approaches, small businesses have a much larger set of resources to work from. So that's the good news. You can see a short list of the companies that we're talking about here, and we'll keep referencing these companies as we go along. On Deck, Billflow, Lending Club, Kickstarter, all are operating these new kinds of online capital for your business. So that's the good news. There's kind of a dark side or an underbelly to this that's kind of important to know. One is online lending tends to be more expensive than traditional banks. Traditional banks are going to be harder to qualify for a loan, but their costs will be generally lower than online banks. Online banking companies are going to be easier to qualify for, and you're going to find them much more aligned with the specific kind of loan you need for your business, but they're going to be more expensive. And we'll see a slide a little later on that will show the relationship between the access to capital and its cost. The other piece of this that's important to recognize when you're thinking about these changes in capital sources is that there are a lot more people that are applying for these online loans than there were in the olden days when people would go to banks. So your competition for applying for and receiving these loans is a lot greater today than it was for your fathers and mothers or your grandfathers and grandmothers when they were looking for cash for their business. So what's it look like? So technology is streamlining the process of getting a small business loan. There are a lot more choices available to you as a small business owner. The application process is shorter and easier. There's less paperwork. There's typically speaking, the loans that are being done by online lenders are smaller in amount than there were than the traditional lenders. Typically, online lenders will work with your business. You don't have to be in business as long, but often they do require specific collateral or some way to guarantee that you're going to pay that loan back. So you can kind of see how it's changed from a traditional lender perspective to an online perspective. So let's look at some of the new financing options that are out there. Over the next few minutes, that's what we're going to talk about is 5 different ways that people are now able to access lending debt using sort of current contemporary technology, primarily online lending. So the first one we're going to talk about is nonprofit online lenders. These are companies like Kiva Zip, Axion, and Tilt Forward. And these lenders typically work with what's called a microloan. So these are oftentimes $5,000 or less, although sometimes they go higher. So it really depends on who you're working with and the purpose of your loan. Now that's a theme that we'll talk about a lot as we go along here. The purpose of your loan. Remember that that's almost the centerpiece of what you're what your qualifying and your criteria is for who you're going to approach for these loans. What's the purpose of the loan? So the way it works, depending on the lender, there oftentimes are no interest rates or low interest rates, low fees. These are often organizations that are mission-driven or community-oriented lenders who want to stimulate growth in a local community. So if you're a local business owner that's serving local residents, local citizens, and you have a business that serves the public, oftentimes these nonprofit lenders are a good source of loans. The other thing that these organizations do that's important is they give you connections into your community. So if you go to a community development corporation that's serving your local community and you talk to them about loans or grants that they may have, not only will you get information about funding, but you're going to learn and meet the movers and shakers in your community. You're going to hear about what's important to community leaders in your community. So I'm encouraging you, regardless of where your business is, if it's a local business serving local citizens, look for those local organizations. Oftentimes, they're nonprofit lenders that can help you get connected and integrated into the community. These are a good option for startups that don't require a lot of capital, but can leverage a small amount of money to make a big impact. Many of these lenders offer mentoring and advice to help a young company grow. And because they're typically offering small loan amounts, they're probably not a good fit for companies that need a lot of capital. So we're talking about loans in the $5,000 to $10,000 range, kind of at the most. So if you need more than that, this is probably not a good option. So here's an example of somebody who might do well with a nonprofit loan. Somebody who's got an eco-friendly clothing retail store that donates a percentage of their sales to charity. They work locally. They employ local employees. They've got a shop, a storefront, or a shop that's local. Those are the kinds of people that probably really benefit the most from nonprofit loans. These are startups, they're mission-driven businesses, they're local businesses that serve underserved communities. And again, these are Axion, Kiva Zip, AEO, Tilt Forward are kinds of companies that do this kind of thing. A question you might ask here would be, what if I don't have a good credit score? Can I still do business and get a loan from a nonprofit lender? And the fact is that many nonprofits look at other data points to mitigate the risk to their loans. So in some cases, your credit score will only be part of the equation. For example, Kiva Zip will offer you a loan if you get 5 people in your personal network to lend you at least $5. I thought this was pretty cool. They feel like your reputation should matter in the loan decision-making process. And if your friends will lend you money, so will they. So this kind of goes back to that notion of friends and family, right? It's really worthwhile considering starting there, regardless of what your loan needs are, thinking about how that can work for you better. Another question might be, what if I need more than just a few $1,000s? Well, if that's the case, you probably want to look elsewhere and not spend a lot of time on nonprofit lenders because their max is going to be somewhere in that 5 to 10. A quick story that might be of interest to you. I worked with a SCORE mentee who wanted to start a credit union in the Aurora area, serving a part of the community that didn't have any banking institutions. They were sort of a banking desert. So people that lived in that community had to go outside their community to do banking unless they did it online. And so this guy, this group of people wanted to set up a local credit union that would serve the local citizens. Well, what they found is that the regulations for running a credit union were too onerous and required too much work and too much effort. So they changed their course, and what they did instead was they set up a community development corporation. And the way they're working is they have some high net worth individuals who are willing to put money into the CDC. So, maybe there are 3 or 4, 5, 6 people who have $10,000 that they want to put into this fund. And effectively, what this fund then does is they work with small businesses to lend them money to get them started or help them with their business, working capital issues or whatever. And the way it works is the CDC organization takes money, say $10,000 on behalf of somebody that they're lending to, and they put it into this credit union on behalf of the person that's going to be using the money. So effectively, 2 things happen. One, there's cash on hand for the individual that's borrowing the money in the credit union on their behalf that's working as collateral so that they can get the loan. The second thing that's happening is that individual is now developing a credit history. So they're borrowing money, they're paying it back, and they're showing their credit worthiness through this approach. And I think it's a really great way to serve the community, help small businesses, and get people on their feet. So if you're a local business, you're thinking about doing some sort of local centric business, I would look at community development corporations in your area, talk to them, see what they offer, learn from them who the movers and shakers in the community are, become part of their network. All of those things benefit your company long term, well beyond the benefit of any loans that they give. So another type of funding that we're going to talk about is crowdfunding. And I know in years past, this got a lot of airtime. A lot of people are talking about, GoFundMe and what they did and how they got their big sums of money. But I wanted to kind of cover this because it's an important part of sort of the resources available to you. Crowdfunding is just another option that can be good, particularly for startup businesses. So here what we're talking about is somebody who comes to a crowdfunding site or platform with a business idea, they pitch that business idea, and then the investors or the lenders that are participating in the crowdfunding platform evaluate it, they compare it to other options that they might have or other people that are pitching their ideas. And if they like your idea, what they do is they provide cash or funds to help you develop it. So that's kind of the way crowdfunding works. And there's really 3 ways or 3 different crowdfunding models that we'll talk about here in a little bit. The other thing to note about crowdfunding and these platforms is that they tend to focus on specific kinds or types of business. As an example, Kickstarter, who's referenced here, they focus on products or services that emphasize creativity. So they tend to look at people that are pitching ideas on their platform and evaluating them through the lens of being creative and being innovative. So that's something to consider as you select a crowdfunding platform. What do they specialize in? Do they specialize in particular industries? Do they consider particular types of businesses being premier or favored? That's something to. The other thing that crowdfunding does that I think is so interesting, and it speaks to something beyond funding, is this notion that crowdfunding gives you an opportunity to test market your business idea in front of a lot of people, so that you've got kind of quick market feedback as you pitch your idea. Now, I don't know how many of you are familiar with agile development. Agile development is a software sort of philosophy that I think is so helpful in the software business. But they have a precept, a kind of a rule that they go by that I think is so interesting, and that is fail quickly. You want to be able to try out your business idea, and if it's not going to work, you want that feedback quickly, as opposed to lingering over months or years of time. So this crowdfunding notion of testing your business idea is a good way to kind of understand the market receptivity to your business idea. And if it's not going to work and you've got no takers, consider that a blessing, because it's good to know, people aren't willing to invest in it, or people don't see it as a valuable product. So there are three types of crowdfunding, and they're very similar, but they have some subtle differences, and we'll talk about those three types here. The first type is what's known as donation or purchase-based funding. And this is where individuals will commit money to a company or an entrepreneur for their business idea in exchange for products or services or perks and rewards. So this is where, you pitch your idea, people like it, and based upon investing in your business, what you're doing for them is you're providing them a service, or you're providing them products, or you're providing them some sort of rewards that benefit them. And that has been successful for a number of different companies. The next type is a loan-based funding model. So crowdfunding here is it's kind of like pitching to a broad spectrum of lenders and finding people that are willing to loan you money. In this case, it's something that you have to give back once your project or your business is up and running. So it's a loan, it's a debt. Typically, these do come with some kind of interest or fee, but here again, you're making a pitch, people are buying into your vision and your business, and they're lending you money, and then you're paying it back. The third type is what we call investment crowdfunding. This is a little bit different, because here what's happening is businesses are seeking to basically fund their business through selling an equity stake in the company. So here what we've got is maybe 10 individuals, each that invest $5,000 in exchange for a 10% equity stake in the company. This is a pretty interesting way to go, and a lot of people are taking this approach, but there's some things you should be aware of. First of all, the government does require that only qualified investors can participate in this kind of crowdfunding. So there's a qualification process that happens here when you're doing investment crowdfunding. So you should check with the Secretary of State of Colorado to see whether there are unique rules, particular particularly for your type of business or what you're trying to pitch in the way of crowdfunding. Crowdfunding is legal in Colorado as of 2015, so we know you can do it. But there are some hurdles that you have to overcome as you when you do crowdfunding in the state. Talk a little bit about that. Was there a question? Okay. So from an overall crowdfunding point of view, most crowdfunding platforms will require a fee or a percentage of the capital you raise. So expect something like 5% of the funds raised will be their potential fee. Crowdfunding platforms give business owners the opportunity to get in front of a lot of different potential investors who might be interested in your product or services, allowing individuals with limited funds the ability to participate. So here again, this is the notion that you have access to a wide variety of different people by just doing 1 or 2 or 3 or 4 sales pitches, being in front of these people, giving them an opportunity to learn about your business, learn about the products and services that you offer. It can be challenging. Many projects don't get funded with crowdfunding platforms, and most platforms take an all or nothing perspective regarding who gets funded and who doesn't. Which means, for example, if you don't meet your funding goal, typically you don't get any of the money that people were willing to crowdfund you with. So the way typically it works is that you set a goal with the crowdfunding platform. That goal then has to be reached in order for the crowdfunding funds to get to you. The state of Colorado does have a few important guidelines on the website for the Colorado Division of Securities. So I'd encourage you to look there if you decide to take this route. Okay, so here's an example of somebody that might be well served by going the crowdfunding route. So this is an individual that has an idea for a kitchen accessory. It'll cost them $15,000 to design and order the first 5,000 units. And so they go to a crowdfunding platform. They get people to agree that this is a good idea, and they're off and running with that money. So this is a fit for not yet established businesses with a great idea for a product, or somebody looking for market validation. Another interesting trend that's out there is existing businesses that are looking at expanding, maybe bringing on a different product line, or bringing on a new aspect to their business. And what they're doing is they go to crowdfunding platforms and they pitch the idea of raising capital for this new product line or this new expansion. And oftentimes what will happen is that'll be considered like a new product, and they'll get crowdfunding support. So that's another option with regards to who's a good fit for this. As I mentioned earlier, it's a good fit for young businesses or startups. So it's something that you might want to consider if you're just getting started and thinking about where to look for funding. Again, friends and family first, but this might be another option. Some potential questions that you might have. Does it matter how long you've been in business when you think about crowdfunding? The answer is no. In fact, all that really matters is that you've got a good idea and you can convince a crowd that you've got a good plan and a good vision for how to grow that business. Presentation. Yes, sir. What are some of the challenges associated with crowdfunding? Most successful campaigns require the business owner make an online presentation or pitch of some kind that's compelling enough to convince potential investors to choose your idea over someone else's. And so this is where that competition comes into play. You've got a lot of other people that are spending time developing presentations and their pitches to crowdfunding platforms. So don't go there with kind of a lackluster idea of what you're looking for or how you're going to spend the money or what your vision is. You've got to come prepared to convince people that they should invest in your business. Okay. Here's an example of an individual, and I love this story because this is so cool. LeVar Burton wanted to start an online library of interactive children's books. Kind of innovative new idea. He went to Kickstarter. He set his goal for $1 million, and he raised $6.4 million in his first month trying to do fundraising to crowdfunding on Kickstarter. I have to say he's an exception. Not everybody's going to get that kind of response. But what it does say is that it is possible. And it's proof that crowdfunding can and does work. So at least consider it as an opportunity for raising funding as you think about how to fund your business. The next thing we're going to talk about is invoice financing. Now, I'll say at the onset here, as might be implied by the title, this is not for the startup business who doesn't do invoicing, who hasn't got an existing business in place that's up and running. So this is really for more established businesses, and it's primarily for businesses that are doing business to business or B2B kinds of commerce. There are two types of invoice financing, and actually there are two titles. So you may have heard of invoice factoring or accounts receivable factoring and invoice financing. And they're very similar, but they have one significant difference. It's worth mentioning here. So the idea is that effectively what you're doing as a small business is you're selling your accounts receivable to a third party. So you've got a series of invoices that are out there. They're maybe 30 days, 60 days, 90 days due. So you've got terms where your customers have to pay you in 30 days or 60 or 90 days. And you don't want to wait for that period of time to get cash. So what these companies do is effectively they offer you a way to get cash quickly by giving you money for your accounts receivable. Invoice financing then is a situation where you maintain control over collections of the accounts receivable. So in this particular case, you might work with an invoice financing company. They may pay you for these invoices, but you're still responsible for collecting the debt from your clients. In invoice factoring, what happens is they actually take over the responsibility of collecting that debt for you. Now, that might seem like an easier way to go, but keep in mind, when people are doing debt collection, that has an influence on the experience your clients have of your company. And sometimes you don't want ham-fisted, heavy-handed people doing your debt collection for you. Sometimes it's appropriate, but most of the time it's not. So my encouragement to you is take the invoice financing route if you're going to do this. So invoice financing makes it possible to access capital tied up in outstanding invoices today. rather than waiting for your customers to pay. The financing company will advance you a percentage of the invoice now and pay the balance minus their fees when the invoice is completely paid. Technically, this type of financing is not a loan. The business is essentially selling their accounts receivable at a discount to the finance company. This is usually a better fit for established companies who are paid by invoice from regular customers, typically B2B. And because your invoices serve as collateral, invoice financing can be easier to qualify for than other small business loans, although borrowing costs can be higher. Invoice financing can be structured as a loan or as a line of credit, is another kind of spin on the topic, sometimes called accounts receivables. So something to keep in mind if you're this kind of business. So here's an example of somebody that might do well with this kind of finance. If you're a baker and you do cash sales, so your bakery is on the street, people come into your bakery and you do cash sales, this probably isn't the way you want to go because you're not using invoices. But if you're a baker that maybe has large corporate accounts, so maybe you're selling baked goods to hotels or other venues, and you're doing terms with them, so you're selling on account. You've got invoices that are being submitted, and your clients are paying you in time, then this might be a way to go. Oftentimes, what's interesting here is it's kind of a quick change that these finance companies are not that concerned with your credit score. They're more concerned with the credit score of the clients. So this oftentimes is a good approach if your credit score isn't that great, but you have a good accounts receivable track record and your clients are pretty well established, like Marriott's or Hilton's or whatever. So that's something to consider. With invoice financing, lenders advance a percentage of your unpaid invoice amount, almost or potentially up to 90%. And then when the customer pays the invoice completely, you receive the remaining percentage minus the company's fees. Invoice company fees typically run somewhere between 1 to 5% of the invoice value. So a couple of questions out there that you might think of. What if a customer doesn't pay the invoice? What happens? Well, then the finance company comes to you and expects you to pay. So that's an issue. Another issue that you run into is if your accounts receivable is aged. So you've got invoices that are out there, 100 days, 150 days, 160, whatever. If your significant amount of your accounts receivable is aged like that, you're not nearly as attractive to invoice finance. The other thing is that if you have a record of bad debt, so you're canceling or deleting invoices, that's also not a good sign for people that are looking to fund through invoice finance. So I'll stop here and see if there are any questions. Okay. The next type of lending that we're going to talk about, we're getting down to the last half hour or so, is online business loans. And this is a vast category of online lending that's taking place right now. Because these companies lend smaller amounts of money typically, but their criteria for qualifying for loans and their funding cycles tend to be pretty quick. And so I think what you'll find as we talk about this is that this might be a good resource or series of resources for small businesses that are already established and in business. And again, the thing to remember is, where is your business currently? If you're just a startup and you have less than a year's books to show a lender, this is probably not something that's going to be available to you. Because these lenders want to at least know that you're in business and they can evaluate your cash flows and those. Some of these companies that are listed here are lenders, and while others are more like facilitators or matchmakers, who don't actually provide loans, but rather introduce you to borrowers and other lenders. This group is leveraging technology to make loan processing faster and easier, often offering loans and approval in less than 30 minutes and funding loans sometimes as quickly as 24 hours. So, when you can compare that to what a traditional bank would do, exponentially quicker, easier to get cash from these guys. So that's the good news. The not so good news is that they tend to be more expensive. So that's something that we will talk about here in a minute. So how it works, there's a short application process. You're not required to meet in person. Approvals are generally done quickly. As I mentioned earlier, and often the funding takes place really quickly. One of the things to recognize about online business loans is that if you are in business, you're going to likely have lots of information that's available about you or about your business on the web. And one of the ways that these companies will assess your loan worthiness is by doing lots and lots of web searches on your name, your credit scores, those kind of things. So it's important to know that as a business owner, you want to make sure that your credit scores are accurate, that if you don't have one, you get a Dun & Bradstreet assigned number, and that information about your credit and about your business is accurate wherever it might appear online. So I mentioned earlier that there's a relationship between approval and the ease of accessing capital and the cost. And that's what this is really intended to show. As an example, a traditional bank loan is relatively difficult to get, but usually comes with a lower interest rate or a lower overall cost when considering the fees. As capital becomes easier to get, the costs increase. A relatively easy to get merchant cash advance, which is at the very top of the scale, which means it's high cost, right, can be very expensive. Most online lenders fall somewhere between a loan at a bank and the merchant cash advance. So as you're thinking about where you want to go for funding, keep in mind that not all loans cost the same. Not all lenders operate in the same space or do business the same way. And if you're going to do your research, look for the kind of lender that you're looking for. See if they work in your industry, see what kind of businesses they tend to fund and support. All of that kind of information will help you select a better, more appropriate lender. So now we're going to talk a little bit about something that should be relatively easy to understand, but a lot of times people get confused by it, and I can include myself as part of that. So the simple question is, which would you prefer? An annual percentage rate, APR, of 67.5% or one of 22.5%? So most of us would say, well, shoot, I'd rather have the 22.5% because that implies it's going to be cheaper for me. And if you were thinking about it in terms of the length of time your loan was going to be paid, you would be right. But if you're thinking about it in terms of maybe I want to borrow $10,000, but the purpose of my borrowing is different. So in one scenario, I can pay it back quickly. In another scenario, I want to pay it back over time. Then maybe that 67.5% loan or APR is cheaper. So let's take a look at it here and kind of think through that a little bit. So we're talking about a $10,000 loan at 67.5%. If I pay that loan off in 6 months, it's only going to cost me $1,500. However, if I pay that loan off in 48 months, it's going to cost me $4,800. So it really depends an awful lot on how long you're going to use that money and how soon you're going to pay it back. To kind of give you an idea of what I'm talking about, that top example of borrowing $10,000 and paying it back over 6 months, in that case, your monthly payments would be about $1,900 a month. If the purpose for borrowing that money didn't allow you to increase your revenue or sales, and it wasn't helping you pay that loan back, this would be a poor choice. But if you were buying discounted inventory that you would sell over the next 2 or 3 months, this might be a great way to do it. You take on this high interest loan, but your plan is to pay it off in 6 months, it's only going to cost you $1,500. And the purpose for the loan, this inventory, you're going to sell well in advance of the due date, which is going to allow you the cash flow to pay that $1,900. On the other hand, if you were buying a piece of equipment that was depreciating over time, and it wasn't going to impact your cash flow or bring in additional revenues, this might be a different way to go, because over 48 months, this loan amount will cost you about $310 a month to pay it off. So it really depends on what you're thinking you're going to use that money for, and how quickly is that money going to kick in and contribute to your cash flow or the value of your business, so you can determine what kind of loan really makes most sense. The higher APR loan may be a better choice. Okay, so a little bit more on online business loans, kind of in summary. They typically offer a fixed interest rate with auto debit payments on a daily, weekly, or monthly basis. Something that we look out for. That story that I told you earlier, somebody wants to take money out of your business account automatically on a weekly basis. Understand how much they're taking, what's it based on, those kinds of things, because that can be very, very detrimental to your cash flow. Approvals can be fast, often within minutes. This new breed of lender is looking for strong and healthy businesses with good cash flows, rather than a reliance on the business owner's personal credit. These loans are ideal for purposes with a specific and identifiable return on investment. So know what your ROI is if you get a loan like this. Here's an example of a company that this might work well for. So this is a restaurant with a well-established business. They have a good cash flow. They need to expand. The restaurant typically has a hard time finding financing at a bank, but they're a good fit for an online loan. This is particularly true since they're looking for about, in this example, they're looking for 75,000. A traditional bank typically wants to do bigger loans, so 200, 250,000. That's typically what local banks are. So what kind of businesses are well suited for these kinds of online business loans? The company should be well established. It should be generating revenues. It should be generating a cash flow of some sort, and it should have a strong ROI for what the funds are going to be used for and how they're going to be. So a couple of questions you might have. What if I've already been turned down at a traditional bank? Second, what if I've already been turned down at a traditional bank? Can I still apply for an online small business loan? The answer is yes, you can. Typically, traditional local banks are going to have a much higher requirement for qualifying for their loans than online banks are. Are these loans more expensive? Are online loans more expensive? And the answer is they are. As access increases to funding, the cost for those loans goes up. So you want to make sure that you understand what those costs are, but it may pay off for you to have an online loan that you can fund and that you can pay back quickly. That may be a good option. Another question might be, how long have online lenders been around? Are they legit? They've been around since about 2007, so quite a while, 15 years, 16 years. Karen Mills, who is the former SBA administrator, identified online lenders as a legitimate source of capital for small businesses as banks move upstream to bigger businesses and bigger loan amounts. So they are legit. They are a legitimate source of capital. Okay, the next and last one of the 5 that we're going to talk about is loan matching sites. And this is kind of an interesting idea, kind of a combination of concepts of crowdfunding, concepts around friends and family. So in this situation, loan matching sites aren't lenders. But what they're doing is they offer small business owners an opportunity to find a lender by completing a brief business profile. And then what happens is these matching sites match you up with borrowers and lenders that meet your profile. The SBA actually has a service much like this. And that uses the same technology. So if you're not familiar with it, you can go to the SBA website. It's now called something different. It's not SBA Link. It's SBA Loan Match. But they offer a good way to connect and find lenders that might be well suited. Other matching sites will match borrowers to banks, credit unions, online lenders, even merchant cash advance companies, depending on your profile and what it is that you're looking for. So these are companies that can put you in touch with lenders based upon a specific profile. These loan matching sites typically don't cost you anything. The funders typically will pay the fees for these sites. It does give you an opportunity to get in front of a lot of different lenders very quickly. So you take your profile, and then these companies distribute your profile to a wide variety of lenders. So this is a good way to kind of leverage the information about your company quickly. Good matching sites will filter out any lenders that wouldn't be a good match for you, helping you save time, getting some of those 33 hours. A client, that uses one of these sites might have access to banks or other lending institutions, online institutions that they wouldn't normally be aware of. So somebody in Colorado might find a lender in Oklahoma or New York or California. So there's an opportunity here to get access to lenders that you maybe wouldn't even know about by using the loan matching site. You still have to apply for each individual lender. So once you're matched up with a lender, you still have to apply for that. And because you may be matched up with multiple lenders, you're going to have to go through that process of applying or deciding which one you're going to go with based upon what you've learned about them. These matching sites offer an opportunity to kind of align yourself and your business with lenders that specialize or work with companies like yours, whether it's the length of time you've been in business or whether it's industry that you're in, or whether it's the purpose that you're looking to borrow money over. These matching sites help match you up with the right lender who specializes in that kind of loan. So they're very helpful, and you may find that to be a great resource. Before we move on to this next section, I wanted to check and see if there are any questions. Anybody have any questions out there? Yeah.
I think I missed this, Mike, but just wanted to make sure on that that chart with the sliding scale was factoring. Does that include like the CDFIs, CDTs, things of that nature?
So the CDCs, not that I'm aware of it, maybe some of them will do factoring.
Okay.
Most of the companies that do factoring specialize very specifically in accounts receivable.
Those business. Okay, got it.
Okay. So how do you know, given these different funding sources, how do you know which product is right for you or which company is right for you? And we're going to talk about that for a little bit and kind of think through that maybe for a while. So here, as you remember, I mentioned it all has a lot to do with what the purpose of the loan is. And I want to emphasize that again. Your capital needs and who you borrow from is heavily influenced by what the purpose of the loan is. The financing needs to, if your financing is to purchase inventory, those are going to be very different needs and very different lenders than if you're going to be purchasing equipment, or you're going to be buying real estate, or you're going to be expanding into a new location. So thinking about the purpose of your loan is going to help you decide who is going to be a well-suited lender for you. As an example, if you're looking for purchasing inventory, or you're looking for some sort of working capital cash infusion to help you over a seasonal adjustment or a seasonal bump or bit of expansion you're trying to do. A short-term loan might be a much better solution for you than a long-term loan, even if it's at a higher interest rate. So that's going to boil down the lenders that you talk to a group that does short-term online lending. If, for example, however, you're thinking about buying a piece of real estate and building a factory on it or whatever, that kind of lending will probably be best suited for a different kind of lender. Somebody who maybe has a better interest rate that they offer, better terms that they offer. Maybe it's going to a more traditional bank if you're looking for larger types of loans. So it all depends on the purpose. It also is implied here that it also depends on what stage your business is in. If you're an early stage company just getting started, as we mentioned during the presentation, some of these lenders are well suited for you, other of these lenders aren't. If you're in a growth mode in an existing company, other lenders are better suited than perhaps the ones that would be best suited for startup. So it really depends on what stage your company is in. That also influences which lender you want to work with. Here are a couple of examples of different financing scenarios that might be helpful. So if you want to open a new franchise location, you're probably talking about a pretty expensive project. Here, the example is $300,000. So the lending products might be a loan matching site that matches you up with a company that does that kind of lending. Or it might be an online business loan with a longer-term loan associated with it. That would be different than if it was a new product development and you only needed $15,000 in cash. That might be a good option for crowdfunding or a nonprofit lender if the circumstances work in favor of nonprofit lending. Maybe you want to buy discounted inventory and you need the money quickly. Well, a short-term online business loan might be right up your alley. That might be something. Even if it's at a high percentage rate, but you're planning on paying that loan off quickly. I'll re-emphasize the fact that you need to understand, once you take that loan on, what your cash flow is going to look like, and how quickly and how able are you going to be to pay that loan back in that short 6 month time frame. Maybe there's a cash flow during receivables gaps that you need, or maybe you run into an emergency and you've got all of this accounts receivable out there, but you need $25,000 quickly. Well, invoice financing might be a way to help you kind of bridge that gap, or a short-term online business. The last scenario here, you launch a first campaign for marketing. You're a local business. You want to promote and market locally. Maybe what you do is you talk to a nonprofit lender that does business in your community. That might be a good source of lending. What I haven't mentioned, and I want to reinforce one more time, what I haven't mentioned here is friends and family. If you're thinking about taking on a loan, my encouragement to you is start with friends and family first. There's a resource at the end on the last page that I'll share with you here in a slide or two. And, there's a great article about how to do friends and family financing. And SCORE will be doing another workshop in August on friends and family financing that might be helpful to you at the time is right for the business. Last but not least, 4 questions that you should ask yourself with regards to how do I start my search? So unless you have a pretty good credit score of 680 or better, it probably doesn't make sense to apply for a loan at a bank. But an online loan would be an option for you. If you're a startup, an online loan might not be a good option, but a nonprofit lender or crowdfunding might be a good option. So the thing you need to do is kind of know what you need and the source of and what you're going to use the loan for. Most lenders, for example, don't want to hear from you when asking the question, how much money do you need? They don't want to hear, I want as much as I can get. That's not a good answer. The right answer is a specific number that fits your business need, that fits the purpose of the loan, and that you know is going to provide a return on investment for you that will allow you to cash flow and pay the loan back. Also, depending on the lender, there'll be additional information that if you can have it in advance of applying for the loan, it'll make the application process a lot faster. For example, if you're applying for a traditional loan at a bank, you'll need a profit and loss statement, probably for the last year or two that you've been in business, and other financial reports such as sales reports, balance sheets, those kinds of things. If you're applying for an online loan, you'll need to have at least 3 months of bank statements to complete the application. It really depends on the type of lender that you choose to use. So this kind of brings us to the end of the presentation. Here is the list of references that I thought would be helpful. You can see them there. The first one is tips on raising friends and family around. The next one, invoicing, financing, what is or works. That's a helpful one. The basics of crowdfunding is a good document to help you kind of navigate that. Crowdfunding specifically in Colorado, the next document is helpful in understanding what the requirements are for crowdfunding in the state. And then small business funding talks a lot about what you need to know with regards to online lenders and some of the things that you need to consider. So those resources will be provided in this deck. I'll send this out to you tomorrow, and hopefully you'll find them good resources. The underlying message here is do your homework ahead of time as you're looking for lending sources. Know what you're going to lend, know how much money you need, know who your lenders can be. Make sure that you understand what the ROI is, and recognize that starting with friends and family is going to be a much easier way to go if that's available. Okay, thank you very much. I'll open it up for questions if there are any questions. Otherwise, I'll give you 10 minutes in your valuable lives back. Any questions?
I have just feedback. I thought the presentation was great, especially because everything was well compartmentalized, but also with some type of visual or illustration so that you could follow along with what this scenario would actually look like.
Great. Well, that's good to know. Thank you. Thanks, everybody, for the feedback. I appreciate it. Again, please enter your email addresses so that I can make sure that I get the presentations to you. As part of the presentation, I'll also be sending you my speaker notes. So you've got that information to go along with it. So hopefully that'll be worthwhile. I'll stay online for a couple minutes. But that's the end of the workshop. Thanks very much, everyone. Have a good evening and enjoy the Memorial Day holiday. Be safe. Thanks.
Hi, can you hear me?
Yes, I can hear you.
I